So we've had decades of low interest rates, and now we've gotten turning away from globalization a little bit after the pandemic, and Russia is now starting a war with Europe. So what does that mean? Well, it kicks in inflation. So what comes next, right? Well, one big fear that folks have is of a blow-up, like a financial system that's been used to low rates, and it's going to wake up to the really high costs of borrowing money. Now, one mid-sized lender, Credit Suisse, that's under pressure, right? But that's in Europe, and it's unlikely that banks are becoming a pretty big problem because they have pretty big safety buffers than in the past. They have a lot of cash. So now the dangers are other places, right? And in the financial system, it's not really reliance on banks. It's more on fluid markets and technology. The good news is your deposits, they're not going to disappear. Your cash is safe in the bank. The bad news is this financial system and consumers, it's kind of opaque to everybody and super sensitive to losses. We can already see some of this happening in the credit markets. Firms that buy debt are kind of turning away from risk. And that means that the interest rate on mortgages and junk bonds go up, right? The market for leverage loans that are used to finance corporate buyouts is kind of like, it's all seized up. It's got constipation. If Elon Musk goes out and he buys Twitter, the resulting debts could become a pretty big problem for banks and for other people. So meanwhile, you got investment funds, including like pension schemes. They have losses on the portfolios of all these liquid assets that they've built up. And parts of the plumbing for money could stop working. Now, the treasury market, it's become a little bit crazy, a little bit erratic. And European energy firms, they're facing big calls, collateral calls on their hedges. Again, Russian war. So Britain's bond market is in total chaos because of obscure derivative bets that were made by pension funds. Now, if these markets stop working really well, if they slow the flow of credit, or if they threaten like contagion in the financial markets, central banks might have to step in. Already the Bank of England, they've kind of turned around and they started buying bonds again, and they're cutting against its simultaneous commitment to raise rates. So this is crazy. The belief that central banks are not going to have like the strength to follow through on their tough talk is behind another big fear, that the world is going to turn back to the 1970s stagflation, really like out of control inflation. So this is alarmist. It's probably not going to happen. A lot of people are forecasting inflation in America is going to fall from 8% down to 4% by next year. That's because energy prices are going to fall and higher rates are going to kind of kick in. But the odds of the inflation going to 20% are tiny. We're still kind of worried about it. And we don't know if we can kind of pull it back down to 2%. 2% inflation is kind of what you want. It's what we used to have. So you've got like these moving targets right now. So if you want to look behind all this craziness, you want to look at what's called long-term fundamentals, what's going on in the long run. And the big shift that we've seen from the 2010s, you've seen a structural rise in government spending and investment. It's now underway. We didn't spend before, now we're starting to invest. Older citizens need better healthcare. Europe and Japan have to spend more on defense to counter threats coming from Russia and from China. Climate change, and we need to have security that's going to boost our investment in energy, from renewable infrastructure to gas terminals. These are things that we need. And you've got geopolitical stress. Again, Russia, it's leading governments to spend more on industrial policy. So as all this investment increases, how old we get or how young we are is going to lean more heavily on rich economies, right? Rich economies, we're going to be older. As people get older, they save more. And this extra savings is continue to act to depress the underlying real rate of interest. That's what happened in the past couple of decades. Boomers saved a lot, interest rates fell. So because of all these trends that were in the 2020s and the 2030s, it's leaning towards bigger government, but still low real interest rates. Now for central banks, they got a problem with this. In order to get their inflation down to their targets of about 2%, they have to tighten enough to cause an economic recession. This means a higher human cost, like we're going to lose jobs. So people might lose jobs, and people are going to get really pissed off. There's a political backlash. Take a look at what's going on in France right now. So if the economy kind of slows down, you can end back in this low growth, low interest rate trap of the 2010s where we're not growing enough. And central banks, they don't have enough power, they don't have enough oomph or gas for like stimulus tools to boost the economy. Now the temptation now is to find another way out. You can ditch this 2% inflation target that we got, and you can raise it to 4%. That means prices go up higher, right? So if you don't get a pay raise, that sucks. Everything gets more expensive. We don't like that. So that's what's on the menu now. The Federal Reserve Bank is talking about this. They got to come up with something in what's called a strategy review for 2024. So all this like higher government spending and higher inflation can have like a bunch of advantages for us. In the short run, it means less severe recession or maybe no recession at all. And in the long run, it would mean that central banks, they have more room to cut interest rates down in a downturn. And it reduces the need for bond buying and bailouts whenever anything goes wrong, or a banker does something stupid, or I don't know, we buy something stupid. That can cause an ever greater distortion of the economy. But it's still dangerous. Central bank's credibility kind of gets hurt and it gets damaged if we start moving these goalposts all over the place. We kind of act like we don't really know what we're doing. So, what do you think? Is 4% inflation where we're going to end up at? 2% is what we had for a long time, and it allowed for a pretty good economy. But it meant that lower wages for low-income workers, a bunch of problems. A lot of folks weren't happy with it. What do you think?